Silver has spent years living in gold's shadow, dismissed as the smaller, quieter cousin that never quite earned a seat at the table where central bankers and sovereign wealth funds make their biggest decisions. That changed the moment the Federal Reserve said something most viewers never expected to hear about a metal so many had written off as industrial scrap with a shiny reputation. In a single policy signal, buried inside language most people would scroll past without a second thought, the Fed quietly rewrote the assumptions that have governed silver's place in the global financial system for decades. What looked like a routine statement about interest rates and inflation targets was, to anyone paying close attention, something far more consequential. A signal that silver's identity is shifting beneath the surface of every trading desk in the world. Before we go further into what the Fed just changed, it's worth remembering where we left off yesterday, because the two stories are connected in ways almost nobody has noticed yet. Yesterday, we watched gold's rally break apart in a matter of hours, a climb toward record highs that reversed into a wave of selling so fast it wiped out billions before most investors even understood what was happening. Underneath that correction was a story about rising real yields, a bond market quietly punishing any asset that pays no income, and a psychology of crowded positioning that had convinced traders gold could only move in one direction. But the real twist came from somewhere unexpected, because Bitcoin began reacting to the exact same macroeconomic pressure that has driven gold for half a century, a pattern that told professional investors something deeper was shifting in how capital defines safety itself. That shift traced back to a single mechanism, the real interest rate, the quiet force that determines whether holding a non-yielding asset feels smart or expensive depending on where inflation and bond yields stand. Once you saw that mechanism clearly, the correlation between gold and Bitcoin stopped looking like a coincidence and started looking like the early signs of a much larger transformation and what counts as a monetary hedge. That transformation is exactly where today's story picks up, because the Federal Reserve just gave silver a new identity, and the implications reach far beyond a single afternoon of price movement. If yesterday's breakdown of gold's psychology gave you a new way of seeing the market, make sure you're subscribed, because what happened to silver this week connects to that story in a way that very few analysts have publicly pieced together. For most of modern financial history, silver has lived a strange double life, half precious metal, half industrial commodity, never quite trusted by central banks the way gold is, yet never fully abandoned by investors, who sense it holds more than meets the eye. That dual identity has always made silver harder to predict, because its price gets pulled in two directions at once, one rooted in monetary fear and the other rooted in factory demand, solar panels, electronics, and the machinery of the real economy. But something in the Fed's latest communication suggested policymakers are beginning to think about silver differently, framing it less as a volatile industrial input and more as a strategic asset tangled up in the same inflation and currency concerns that have always surrounded gold. That distinction might sound subtle to a casual observer, but to institutional money managers, it is the kind of language shift that changes how an asset gets modeled, weighted, and eventually allocated inside portfolios managing trillions of dollars. And if you're watching this from Karachi, Manila, Toronto, or anywhere else this story is reaching tonight, drop your city in the comments, because this audience spans more corners of the world than most people realize, and that global attention is exactly why this signal matters so much. To understand why the Fed's words carry this kind of weight, we need to look at the actual mechanism connecting silver's industrial role to its monetary one, a relationship that has quietly determined every major silver cycle for the past 50 years. That mechanism is where the next part of this story begins. Silver's dual identity has always been the key to understanding why it moves the way it does, swinging harder than gold in both directions, because it sits at the intersection of two completely different kinds of demand that rarely move in sync. On one side sits monetary demand, the same fear-driven buying that pushes investors toward gold whenever confidence in currencies wavers or inflation threatens to outpace savings, a force rooted in centuries of silver being minted into coins and stored as wealth. On the other side sits industrial demand, a modern and rapidly growing pressure coming from solar panel manufacturing, electric vehicle production, and electronics, sectors that consume silver not because they trust it as a store of value, but because its conductivity makes it irreplaceable in certain technologies. For decades, these two forces mostly canceled each other out, keeping silver locked in a strange secondary role, too industrial to be treated purely as a safe haven, yet too historically monetary to be priced like a normal commodity such as copper or aluminum. That tension is precisely what makes the Fed's recent language so significant, because when a central bank starts describing silver in terms usually reserved for gold, it suggests policymakers themselves are beginning to blur the line between silver's industrial identity and its monetary one. Central banks do not choose their words carelessly, especially in official communications that traders, economists, and algorithmic models dissect within minutes of release. searching for even the smallest shift in tone that might hint at a change in how risk is being assessed behind closed doors. When that language leans toward describing an asset as a hedge against currency debasement rather than simply an industrial input, it signals something important about how institutions may begin treating that asset inside portfolios built to withstand inflation and fiscal uncertainty. This is where silver's story starts to intersect with the same forces we traced through gold and Bitcoin, because rising government debt, persistent questions about long-term fiscal sustainability, and a bond market demanding higher compensation for risk do not stay contained to a single asset class. If real yields are the mechanism connecting gold and Bitcoin, then silver has quietly been sitting adjacent to that same mechanism all along, just partially obscured by its industrial demand, which made its monetary signal harder for casual observers to isolate. Once the Fed's own language starts nudging silver toward the monetary side of that equation, institutional models that decide how much of a portfolio should sit in inflation hedges may begin treating silver less like a cyclical commodity and more like a strategic reserve asset. That shift, if it continues, would represent one of the more significant repricings in the metals market in recent memory, because silver has historically traded at a steep discount to gold on a monetary basis, a gap analysts have long debated without a clear catalyst to close it. A reminder here for anyone just joining this story mid-episode, because if this kind of deep, connected analysis is useful to you, hitting subscribe means you won't miss the next chapter, and dropping a like helps this kind of long-form breakdown reach more people who are trying to understand these markets seriously. Beyond the Fed's language itself, there is a structural backdrop that makes this moment particularly sensitive, because global silver supply has struggled for years to keep pace with the combined pull of industrial consumption and renewed investment interest. Mine production grows slowly, constrained by the years-long timelines required to bring new deposits online, while demand from solar energy alone has expanded rapidly enough that some years have produced meaningful supply deficits, a dynamic gold rarely faces, given its far smaller industrial footprint. When a market already running tight on supply receives a signal that a major central bank is beginning to view it through a more monetary lens, the conditions exist for a very different kind of price behavior than silver has shown in previous cycles. That is not a prediction of where price goes next, because no responsible analyst treats supply tightness as a guarantee of any particular outcome. But it does explain why this Fed language landed with more weight than a casual comment about metals markets normally would. To understand exactly how markets responded in the hours after this signal emerged, and why some traders are already comparing this moment to earlier turning points in gold's own history, we need to look closely at what happened next inside the futures and options markets, where the real reaction was unfolding in real time. Within hours of the Fed's language circulating through trading desks, the futures market began showing a pattern that seasoned commodity traders recognized immediately, a quiet but unmistakable shift in positioning that often precedes a larger repricing rather than following one. Open interest in silver contracts started climbing, not in the frantic, headline-driven way retail speculation typically enters a market, but in the slower, more deliberate rhythm associated with institutional desks building positions methodically over multiple sessions rather than chasing a single day's move. Options activity told a similar story, with increased demand for contracts that would pay off if silver moved meaningfully higher over the coming months, a signal that some professional investors were positioning for a structural shift rather than a short-term bounce. None of this guarantees a particular outcome, and it would be irresponsible to claim otherwise, but this kind of positioning shift is exactly the sort of detail that historically shows up in the early innings of a major reassessment, long before the broader public narrative catches up. What makes this moment especially interesting is how it echoes the earlier stages of gold's own multi-year revaluation, a process that also began quietly, with subtle changes in central bank language and institutional positioning, long before it became an obvious, headline-dominating story. Gold's journey from an overlooked, underweighted asset to a centerpiece of reserve strategy did not happen overnight. And it did not happen because of a single announcement, but because a series of small signals accumulated until institutions could no longer justify ignoring them. If silver is now entering a similar phase, the implications extend well beyond the metal itself, touching everything from mining equities to industrial supply chains that depend on silver for solar panels, semiconductors, and the broader electrification of the global economy. A tighter, more monetized silver market could mean higher input costs for industries already navigating complex supply chains, creating a ripple effect that connects a central bank's carefully chosen words to decisions being made on factory floors thousands of miles away. At the same time, for investors who have spent years watching gold's ascent while silver lagged behind, this shift raises a question that is impossible to ignore: whether the historic gap between the two metals is finally being challenged by forces bigger than any single trading session. That question becomes even more pressing when placed alongside everything we uncovered about gold and Bitcoin Because if three fundamentally different assets, one ancient, one industrial, and one digital, are all beginning to respond to the same underlying anxieties about currency stability and government debt, the story stops being about individual markets and starts being about the system underneath all of them. Central banks did not create these pressures overnight, and they will not resolve them overnight either, which means the coming months are likely to bring more of these subtle signals, more carefully worded statements, and more moments where a single sentence quietly reshapes how professional money thinks about risk. For viewers who have followed this series from gold's sudden correction through Bitcoin's unexpected correlation, and now into silver's shifting identity, the pattern connecting all three should be impossible to miss. A financial system quietly searching for new ways to hedge against uncertainty it can no longer dismiss as temporary. If this series has helped you see these connections more clearly, take a moment to like this video. Leave a comment with your thoughts on where silver goes from here and share it with someone who still thinks of silver as just an industrial metal rather than a story still being written. And once again, if you're watching from Lahore, Nairobi, São Paulo, or anywhere else this reaches tonight, let us know in the comments, because this global conversation is exactly what keeps these stories connected from one episode to the next. No one can say with certainty exactly how this chapter ends, whether silver's new monetary identity strengthens into something permanent or fades as quickly as it emerged, but one thing is becoming harder to dispute with every passing week. The old boundaries separating gold, silver, and even Bitcoin are blurring in ways that demand closer attention rather than less. The next signal is likely already forming somewhere in the bond market, in a central bank statement, or in the quiet positioning of institutions who move long before headlines catch up. And when it arrives, we'll be here to break it down together, one connected story at a time.